So this is the chapter 18. You have the ebook, which we're going to go over that right now. And there are points that we like to cover in this chapter. And there is a little bit small description of the chapter here. So let's go to the ebook and see what's going on in chapter 18. Chapter 18 looks like it's talking about cost, volume, profit, and business scalability. Cost, volume, profit analysis will be a very useful tool for all of us as a manager in a business environment. Also, it's a good thing to know because we have a project probably related to cost, volume, profit, and if there is a project, you can use that knowledge to solve that area of the project for the cost, volume, profit. So let's go and start with the next page. Okay, so yes, as you know, we have some cost that is variable. That means a per unit cost that is the same regardless of volume. So variable cost per unit is always same. However, total variable cost increases with volume increases. Very important thing to know from the beginning. So let's go over that one more time. Variable cost per unit is always same. It's not changing. However, total variable cost will increase if the volume of production is increasing. Make sense? However, let's talk about fixed costs. There are some costs that they are not changing. Those are fixed all the time, like rent. So those costs that is the same regardless of volume. For example, rent. Rent never increases. Rent is whatever it is. Doesn't matter how many units you produce. The total cost is constant. Yes. However, per unit cost decreases when volume increases. So fixed cost per unit goes down if the volume of production goes up. However, the fixed cost by itself is always fixed, is always same, no matter what. Okay? So remember that in case you get multiple choice questions, either in my class or in a CPA exam somewhere. Okay, let's talk about variable cost. So as you see here, the total variable cost is increasing as the volume unit production is increasing. So if you have more unit production, you will have higher variable costs. Variable cost per unit is always fixed, is not changing. You see, $11. Variable cost per unit is always same. However, total variable cost will increase if the production is increasing. Are we good? One thing that you might, kind of forget how it goes is the notion that why dollar is in the vertical line and everything else is always at the bottom, like unit production. Look at this one, dollar is at the top, but let's say unit production is at the bottom. Why dollar is at the top, right? I was always asking why dollar is at the top. So imagine you want to draw something like this and you kind of forget dollar is at the top or unit is at the top. How about if we put dollar at the bottom? So in order to not forget this, I have a very funny story, but it works. What is the most important thing at the top of your mind all the time? It is dollar. At the top of your mind all the time. The most important thing in your life at the top of your mind all the time. So here is the dollar. Dollar is always at the top all the time. Everything else, like here unit production, is at the bottom. Make sense? Just remember. Okay, so how about fixed cost? Fixed cost is fixed all the time. Fixed, like here, factory rent, $1.2 million, all the time, fixed. However, fixed cost per unit will start going lower and lower and lower as the unit production is increasing. By having more units of production, then the fixed cost will be divided between more units. Therefore, fixed cost per unit is going down. So fixed cost per unit is changing. Fixed cost by itself is always fixed. Total fixed cost is always fixed. It's not going to change, but fixed cost per unit is changing. So remember that, please. Okay, here is some examples that you can read. Obviously, at this point, we can just move on a little bit. Economic of scale is efficiencies associated with the increase in volume. So if we have more volume production, we have higher efficiency in our production. Economics of scale. That's something that it makes, let's say, American corporations so powerful because they have high volume of production. That's why they are more efficient compared to a small mom and pop business. Okay. So relevant range is an important concept that we constantly refer to that. It's the level of activity for which assumptions underlying cost volume profit analysis are expected to hold true. Relevant range means a range of production that you can easily move in that range, produce a little bit less or produce a little bit more without having a need to rent a new place, a need to buy more equipments. That's your relevant range. So if the relevant range is changing, all of a sudden you want to change your relevant range, then your fixed cost might significantly change. Let's say if you want to increase your relevant range to another level, all of a sudden you need a new factory, another second factory, more equipment, more expense. So your fixed expense is going to go up. So when we are talking about cost volume profit analysis, we always refer to relevant range. That means in a range of production that you don't need to rent a new place or let's say buy new equipment. Okay. Let's go. Here it says about committed fixed costs. Those are costs that rise from an organization's commitment to engage in operation. Unavoidable elements like depreciation, those are committed. Depreciation going to happen no matter what. Rent happens. Insurance is always there. Property tax, you have to pay. So those are committed fixed costs that you cannot kind of change them. We cannot get rid of them. However, we have some costs here that we call it discretionary. Those are costs that you might, some way, somehow, maybe for a month or two, 6 months or something like that, put it aside. Like do no advertisement, let's say put the training aside, no lunch for employees on Friday afternoon. So kind of things that you can put it aside. So good to know. Let's go to the next page. Obviously, you need to read the page one after another carefully, but let me see if I'm trying to, if I can give you better ideas about things here. Mixed cost, very important concept, a cost that has both fixed and variable component into it. The example I can give you, easy example, is utility, like electricity bill. Electricity bill if you don't produce anything, you get, let's say, $100 bill every month. Even if you shut down your factory, still you have to pay that minimum electricity bill, like $100. It's always fixed. However, as soon as you start producing, you need electricity, you start using electricity, and for every unit of production, your usage of electricity will go up. That portion, it's variable. So your electricity bill is not a fixed cost. Your rent, it's a fixed cost, yes, but your electricity bill is not a fixed cost. Your electricity bill is partially fixed, partially variable. We call it mixed cost, okay? So let's see if we can. Okay, so here we have, let's say, a utility bill for water cost. And the fixed cost for utility bill is $1,000 no matter what for this factory, assuming they use no water, right? However, if they start doing production, then they pay, looks like $3 per 1,000 gallon. So they're gonna pay $3 per 1,000 gallon if they start using it. So that will become the variable cost of the mixed cost for the water total cost. So as you see, the fixed cost is always $1,000, but for every 1,000 gallons of water, the variable cost keeps going up and up and up for $3 per 1,000 gallons of water. Okay, so keep this part in mind. Now, these mixed costs, any mixed cost in your business needs to have a formula. You need to create that formula. You have to write it down and you have to stick it on the top of your desk to know how to calculate the mixed cost in your business for future upcoming budget, right? So you have to have that mixed cost formula ready. How can you do that? There's a very easy way to do it. We call it high-low method. There's a little bit harder one, which is regression analysis. We're not gonna do a least square method regression. So it's in this chapter, but you don't need to kind of know it because we're just gonna use high-low method, which is very efficient, good enough, accurate, good enough, and easy to calculate. So here we go, we're gonna cover the high-low method. In high-low method, using high-low method, you can make a formula for this mixed cost. So let's see. Here says, what is high-low method anyway? It says a simple means for separating costs into fixed and variable components based upon the differences between costs at the highest and lowest observable levels of activity. So all you need to have is just, let's say, 1 year of data in regards to the cost, or 6 months of data in regards to the cost. So here we have 6 months, for example, in between April and August. So between last 6 months of operation, we use different amount of water, like 450,000 gallons all the way to 700,000 gallons. And the cost was, based on the bill that we received from Water and Power, the cost is, as you see, at the different levels. So in the high-low method, you choose the highest one and the lowest one, and you go with that. Unless for some reason, let's say if 1 month your water pipe was broken and you lost tons of water, okay, that 1 month is an outlier. So don't consider that as, let's say, high cost, because that was the month that you had a broken pipe. But in general, you take the highest and lowest one to calculate high-low method. So here, as you see in, let's say May, the lowest one is May, 340, and the highest one is August for 2020. I know that. This one, June. Okay, June is 850,000 gallon. That's the highest. So August is not highest. June is highest. So I'm gonna pick up the lowest one, which is May, 340,000 gallons, and June, which is 850. I'm gonna use these 2 months for my calculation. And how do we do this calculation? Let me show you a little bit of the idea of algebra that you probably took the class already. So let me share my screen for a second. What I'm going to refer to is the algebra class that you took possibly by now. We have a formula. Do you remember? It says y equals a plus bx. And y here is the total cost. A is fixed cost. And B is variable cost. Variable cost. X is number of activity. Okay. So far, so good. That was in algebra, right? And now, this is the formula that you want to make it for your mixed cost. So this is mixed cost formula for every type of expense you have in your business. Okay, but how do I know what is Y? How do I know what is A? How do I know what is B? Okay, so using high-low method, you first calculate B. B, which is variable cost, equals to Y2 minus Y1 over X2 minus X1. That means high cost minus low cost divided by higher units minus lower units of use or production or whatever it is. Okay, you might say, how do you know? And this is the diagram. This is X and this is Y, right? You might say, how do you know Y is dollar? I told you already a few minutes ago. Remember, I said, what is the most important thing in your life at the top of your mind? At the top of your mind, that's the dollar, right? And then X automatically will be the other one, which is the, let's say, units of production or units of usage or whatever it might be. So the important part is you need to know where the dollar is, and you need to know where the other thing ends up. So since you know this one, the other one will be at the bottom line. So horizontal. Vertical line will be Y, which is dollar. So here we go with the dollar. So you take the high cost minus low cost. So imagine your costs are separated like that, right? Okay, so you take the high cost and let's say high cost with the production, and let's say lower cost, which is that one, with the production. So that's Y2 X1, and this is Y1 XY. Okay, Y1 XY, Y2 X2. Okay, now you calculate that, and you can find out what is your variable cost. After you find out what the variable cost is, then you pick up one of the high one or low one, doesn't matter. Just pick either one of them, either high or low. Pick up one of them, and you know already what the total cost is in low or high, either one. So you put that B in the formula with the high one, let's say, and then you can find the fixed, because high cost in your bill last 6 months, you know what the cost is high. You know already what is the variable. Now put it inside. You know the number of high cost activity. You will find out the fix. If you don't like high one, use the low one. Again, you have the low one cost, total cost. You need the low one activity level. You already find out what the variable cost is, and you can again find the fixed cost. As soon as you can find the fixed cost, then you create your formula. So let me give you an example here, quick. Let's say your high cost in this example, which I was referring to the book, was $3,550 minus $2,020 divided by 850,000 of gallons minus 340,000 of gallons. So the answer will be $1,530 divided by 510, and that's the B, variable cost. So the answer would be $30, right? So far, so good. Then you will put that variable cost, you put that variable cost in the one of the high or low one. So let's say high one. Let's choose high, for example. So here we say high cost was $3,550 total. That's Y equals A plus BX, right? So here Y is 3,550. A, we don't know yet. However, I know the variable cost is $30 times how many gallons did we use in the high? 850, right? 850. Okay, so 3,550 equals A plus 2,550, and A equals $1,000, which is fixed cost. As soon as you have this fixed cost available, now you easily make the mix cost formula. So what is mixed cost formula now for this water consumption cost for the factory is here. Let's put it together. So Y, which is total mix cost, equals to A is $1,000 plus B, which is variable cost, it is $3. X is units of gallons in this example. Thousand of gallons. X is the thousands of gallons. like 340,000 gallon or 450,000 gallon or whatever gallon you use. So now you have all of a sudden this magic mixed cost formula for your business, water cost calculation. So in future, when you are now making a budget and you get to the point that you want to know how much cost you will have for your water cost based on the assumption and estimate of the production in your budget for the next 12 months, you can easily put that in this formula, say how many gallons I'm going to use this month, let's say in month of January and then in month of February, and based on the production estimation in your budget, and you can easily calculate the mixed cost for your water for every month. So you see, having a mixed cost formula for every type of mixed cost in your business is very crucial. And high-low method is the method that you can use. Okay. Okay, so it looks like we are fine. Let me turn off the camera, share my screen again. And here we go. So, as you see, this is what I did just in last few minutes. So I use the y2 minus y1 equals 510, x2, sorry, this is y2. y2, y, you know why y is dollar, right? I said y is the most important thing. The dollar is most important thing. It's at the top of the equation. And if you see, it says b equals y2 minus y1. Y is always at the top of the equation. X is at the bottom of the equation. So here is y. So total cost for high level cost, y2 minus y1 equals 1530. x2 at the bottom minus x1 is 510. So 1530 divided by 510 gives you $3 variable cost. Now that you know what your variable cost is, put that $3 variable cost in either high or low, either way, choose one of them and put it inside that high or low. And then you know already total cost, which is y, total cost is 3,550. And you know the variable cost is $3 per usage. So the usage for a high was 850. So 850 times 3 is 2,550. Therefore, 3,550 minus 2,550 fixed cost ends up to be $1,000. There you go. You have your fixed cost now. And that's exactly what I did. You can do the same thing in the low cost. So the total low cost is 2020. But in the low cost, we used 340,000 gallons. So 340 times $3 for every 1,000 of gallon. So that will be 1,020 minus 2020. It gives you $1,000 fixed cost. Method for least square, you can read it, but it doesn't matter. We can do this through high-low method easily. So this is just optional for you if you want to read it. And they are using the same formula that I was referring to. Remember, that was the formula. Y is total cost equals A fixed cost plus B variable cost, and X is the number of activity. Again, here is the Y, here is the X, and that's the formula that I was referring to. So B is the slope of the line. Okay, so you read that one yourself if you like to, otherwise you can just skip it. Okay, let's go to break-even point area, which is very important. And if you have a project for cost volume profit analysis, that's part of your project and you can just refer to this again. So cost volume profit analysis is where you analyze the effect of increasing sales, decreasing sales, changing contribution margin, calculating break-even point, calculating target income, and it's very important subject for a business. Okay, so what is contribution margin? Again, contribution margin is different than gross profit. Okay, contribution margin is revenues minus all variable expenses, whether related to production or selling administrative expenses, doesn't matter. Every single variable expense. So contribution margin is revenues minus variable expenses, gives you a contribution margin, which you can contribute towards paying all fixed expenses. Okay. Now, you see, in this example, this is what you need to have for, let's say, a cost volume profit analysis section of your project. And that is knowing that, okay, what's the sales, total sales? What is the variable cost? What would be the contribution margin? How much fixed expense do you have so you can break even? You see, if you have 1,000 units of sales at $2,000 each unit, then you will make $2 million. The variable cost is $800 per unit. So $800 times 1,000, that will be $800,000 total. Contribution margin will be 1.2 million. And that will be exactly same as fixed cost that you need to cover and contribute to pay for it. So to have zero net income and break even. And that's what break even point is. But just because of this, that's not enough. Make sure you have per unit next to it, per unit calculation. So what is contribution margin per unit? It's $1,200 contribution margin per unit. And that's not enough. You need the next row, next column, which says ratios. And you need to say, okay, sales is always 100%, right? But what is the variable cost? Variable cost is 800 divided by 2,000. That's variable cost percentage. What is contribution margin ratio? Is contribution margin 1,200 divided by 2,000, and that's 60%. So those are things that you need to have in a real business or in your project when you are calculating contribution margin ratio. You need to have this thing ready for your production. Okay, so now that you have all this important information, you can easily calculate so many things, okay, which I'm going to show you. In this example here, it shows if the sales goes up by another 1,000 units, your contribution margin goes up. And after paying fixed expenses, you will have net income of $1.2 million. Okay. Again, look at the per unit contribution margin is same, ratio is same, but because the volume of sales went up, the net income went up. And if you sell less than 1,000, let's say just 500 units, then your contribution margin will be only $600,000. And therefore, you will have a net loss of $600 in this case. Okay, now what is break-even point? Break-even point is the point that you make no income. You just break even, but there is no income. So this is your sales line, you see, all the way up. This is your fixed variable line. Start from the fixed point because let's say $1 million is fixed already, or 1.2 million is fixed. So 1.2 starts from 1.2 million, from where the fixed cost is, and your variable starts going up and up and up because you have more production, more units. So this is the point that those two lines are touching each other. That's the break-even point. Anything above break-even point, the green area is the profit. Anything below break-even point in unit sales, below 1,000, it's the loss area. Okay. So look at that picture. And now the question is, how do you calculate the break-even point? You're going to obviously look at this and read this. I'm going to show you the way to calculate break-even point and target income all in one formula. Okay, let me get a paper and show you. So after you read this, obviously, just look at my way of doing it to remember it. It's the same thing, okay, but just how to remember it forever. So I'm going to stop sharing this one again. I will turn on my camera. Okay, here we go. Okay, this is how the formula works. Break-even point in units. What is break-even point in units? How do you calculate that? Equals to, think about it. What is the most kind of important thing for every business owner that he thinks about it every single night? What is it? How to pay my fixed expenses. Every businessman is thinking about every day how to pay my fixed expenses this month. Plus, because I wanted to calculate the break-even point, a target profit of 0. Okay? Because it's break-even point, your target profit is 0, obviously. Divided by contribution margin per unit. Okay? Contribution margin per unit. Unit, 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 unit. Remember like that. Unit, unit. So break-even point in units is fixed expenses, which is the most important issue for every business, how to pay for that, plus 0 target profit divided by contribution margin per unit. It gives you the break-even point in units. How about you say, oh, I want to know what is break-even point in dollar, sales dollar, right? This is sales in unit. This is sales in dollar. What is the break-even point in sales dollar? I don't want unit, I want dollar. Okay, no problem. Here we go. Again, every business is always thinking about the most important issue, which is how to pay for fixed expenses plus a 0 target profit, okay, divided by contribution margin ratio, dollar ratio, unit, 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 dollar ratio. So all you need to do is just put the contribution margin ratio over there, and you will be able to solve the break-even point. Now, Because I already explained this, guess what? If you want a specific target profit and you are not concerning about break-even point, but you want to know what is the sales in unit for a specific target profit, use the same formula. That's it. So I gave you one formula, use it for everything. Got it? That's why you can easily remember it. You will never forget it. It will be a piece of cake. I told you how you think always. Again, what's the most important issue for every business? How to pay for fixed expenses. If you want break-even point, plus zero target profit, divide by contribution margin per unit. If you want to know the sales dollar, say, okay, what is the most important issue for every business to pay? Fixed expenses plus zero target profit, divide by contribution margin ratio. And that's why I said you have to have all those contribution margin per unit, contribution margin ratio from the beginning in your cost volume profit analysis. And you can calculate everything. You can calculate break-even point using this formula. You can calculate target profit using this formula. Here we go. Easy. Okay. Okay, we are good, hopefully. And you are free to look at this because this is exactly what I was explaining. And here is what I was referring to. So break-even point in units is total fixed expenses, which is most important issue for every business, plus zero target profit divided by contribution margin per unit. And if you want break-even point in sales is equals to total fixed expense plus zero target profit divided by contribution margin ratio, and that gives you break-even point in sales. And you can, because my formula is very comprehensive, obviously easily I'm covering the target income also. So we are done on this. Very easy. Okay, those are things that you might want to read. And let's see anything else. And here are different scenarios about changing fixed costs. Okay, so you might have different ideas about, changing some variables or some fixed expenses. So those are some examples of that. Here says, if I want to read it, it says, if Leyland added a sales manager at the fixed salary of $120,000, what would happen? So if a fixed salary is increasing, then the fixed cost is increasing. So from 1.2 million, all of a sudden you have $1,320,000 fixed expense. So your fixed expense is going up. Your contribution margin is same thing. Obviously, your break-even point will change from 2 million to 2.2 million. You see? So that means your manager needs to be efficient enough and good enough to increase the sales at least by $200,000 in order to make sense to hire. For variable cost changing, if let's say you want to say, oh, I want to pay 4% of sales commission to this new manager instead of fixed salary. So your contribution margin will go down because your contribution margin was before 60%, but now you are going to pay 4% commission to the new manager. So your contribution margin is down. Yes, there is no fixed salary, but the contribution margin is lower. In that case, you need to have $2,142,857 sales instead of 2.2. So it's a little bit better. However, this is a good motivation for the sales manager that you just hired with 4% commission to increase the sales to another level and again higher level after that, so he can get more income, right? Because more commission will come through. So that is something that you need to consider, but why not? Why not do that? Look at this picture. If you increase the sales by all the way from 3 million to, let's say, 6 million, like double the sales, then your manager will get more higher income, but you will have much higher income for the company at the bottom line. So it's good idea. It's a win-win situation. The company will make more money, and while the manager is also making a lot of money at that point. And here is an example of blended cost shift. So it says, okay, how about if we get a new jet, for example, and the new jet has a higher contribution margin, will be a good idea to do it. And if you read this, you will see that it will be a good idea. The only thing is just you need to be aware that your previous fixed cost was 30 million with the old airplane, but with the new airplane, your fixed cost is increasing to $4 million, I believe, here. And you need to be aware that in a bad economy, still you have to pay that $4 million. So with the old airplane, in a bad economy, you only have to pay the 3 million fixed cost. But in a bad economy, with the new airplane, if you replace it, you have to pay $4 million fixed cost. Okay. So there is here an example of per unit revenue shift. So what would happen if you have, let's say, increasing the sales price, if you can, by 10%. So if you increase the sales price by 10%, from $1,000, you increase the sales price to $1,100, then all of a sudden your contribution margin will double. Here your contribution margin is $1 million. Here your contribution margin is $2 million. But your fixed cost is the same thing. But that means your net income from 500,000 all of a sudden will be 3 times more, $1.5 million. But the question is, can you do it or not, right? I remember a few years ago, Netflix increased the subscription from, I believe, gosh, maybe $7, something like that, to $15, like literally twice more. And they were thinking they can do that because people love Netflix and they will still pay $8 more, not gonna do anything. But guess what happened? So many people canceled Netflix to the point that Netflix came back, says, you know what, I'm sorry, I'm not gonna do this. I'm gonna put the prices back to that $7 again. And what they did, after year after year and passing, slowly, maybe every 2 years or so, slowly he added $1 to $7. He made it, instead of $7.99 to $8.99, and then he made $9.99, and then he made $11.99. So slowly he started to increasing because he learned his lesson. Okay, so here is another example about variable cost. This is an example that a company makes an agreement with another company in order to let's say to have a 20% contribution margin. That's an agreement they have here, contribution margin of 20% guaranteed to provide bags to HEAP. So Pioneer Plastic was guaranteed in that agreement to have 20% contribution margin. But all of a sudden, it says the cost of petroleum increased. So here, petroleum product increased the cost, and all of a sudden, the variable cost instead of $1 per bag was $3 per bag. But because they have an agreement, so the buyer had to pay more automatically according to this agreement to make sure that the producer, Pioneer Plastics, the producer still keeps that 20% contribution margin. So in that case, the sales price increased like 3 times more almost, right? And that guaranteed a contribution margin of 20%, which is 750 divided by 3,750, that's 20%. Same thing in here, 250 divided by 1,250,000 is 20%. So contribution margin stays same. That means the buyer needs to pay like 3 times more because of agreement. Fixed cost was same, so it was not changing. So all of a sudden, the seller was so lucky because he was making a big amount of money because of this agreement. Now, imagine here says, even the company agrees to have just 10% contribution margin. Still the net income, the bottom line, the net income will be much higher than original scenario. So where you make an agreement with a company and based on the contribution margin guarantee price, so that might change the scenario if future cost, variable cost increases, and increase of petroleum cost is very common subject in economy. Here is the mixed cost, multiple product. So let's go over this because it's a little bit, detailed. So it says, assume that the hummingbird feeders produces and sells brightly colored feeding container for $15. So selling price is $15 and the variable cost is $10 for each feeder. That means contribution margin is $5 for each feeder, right? 15 minus $10 variable cost gives you $5 contribution margin. Okay. So what is the ratio of contribution margin ratio? Just calculate, use your calculator. So $5 divided by $15 sales, that's 33.3% contribution margin. Okay. However, the nectar formula, they sell it for $3 per packet, which is just $1 variable. And that means $2 contribution margin. So feeder has 33% contribution margin. But if you look at the nectar formula, which is $2 divided by $3 sales price, $2 contribution margin divided by $3 sales price gives you a contribution margin ratio of 66.7% contribution margin ratio. So the contribution margin ratio of nectar is much higher. It says hummingbird feeder sells 10 packets of nectar for every 1 feeder sold. its fixed cost is $100,000. Okay, keep that in mind. And feeder, the contribution margin is $5. Nectar packet gives us a contribution margin of $20 for every unit of sales, because remember, 1 unit of sales is technically in average 1 feeder for and 10 nectar packets. So that's, we call it a average unit contribution margin of $25. How many feeders and packets must be sold to break even? So to answer this question requires a redefinition of the units. Assume that 1 unit is 1 feeder and 10 packets. So that each unit, so-called, would have a contribution margin of $25, as you see in here, right? The general contribution margin per unit, overall contribution margin per unit is $25. So to recover $100,000 of fixed cost at $25 contribution margin, so-called unit, would require selling of 4,000 units. How do you know that? Use my formula. Remember, I said break-even points in units is fixed cost minus 0 target profit divided by contribution margin per unit of 25. And that gives you 100,000 divided by $25 contribution margin for the company. That gives us 4,000 units of sales. Okay, but 4,000 units of sales means what? 4,000 units of sales means that means in every unit of sales there is 1 feeder and 10 packets of nectar. So it will be 4,000 feeders and 4,000 times 10, 40,000 of nectars, right? Because every unit, so-called unit of sales is 1 feeder and 10 packets, right here, 1 feeder and 10 packets. So the total break-even sales would be $180,000, which is 4,000 feeders at $15 plus $3 times 40,000 packets of nectar, and that will be total break-even sales would be $180,000. Yes, total break-even point in units we calculated, that was 4,000 of combination of those that we are selling, but the dollar amount will be $180,000. Of course, the validity of this analysis depends upon actual sales occurring in the predicted ratio. Change in product mix will result in change in break-even point. Why? Because as if you read in here, it says the company feeders sold $180,000 in feeders and no packet of nectar, it would come nowhere near break-even point, because feeders, they have just 33% contribution margin. That's not enough. However, if you sell the predicted 1 feeder and average of 10 nectars, then that will be a different scenario, because that will provide you the break-even point of $180,000. So here says also, be careful, you can also calculate that $180,000 resulted by dividing the fixed cost, which is $100,000, by the weighted average contribution margin of 0.555. How do you know the weighted average of contribution margin? A feeder has 33.3% contribution margin, and nectar has 66.7% contribution margin. So 33.3%, which is 0.3333 times 15 out of 45, that gives us a weighted average of 0.111, and $30 sales of nectar out of total $45 sales price per unit. Remember where this 45 is coming from. We are selling one nectar feeder plus 10 packets, right? That's where 45 is coming from. Times the ratio of contribution margin, which is like 66.66%. That gives us 0.44. Add them up. So average contribution margin ratio is 0.55. So in order to know the sales mix, you just divide based on my formula. Remember, break-even point in sales dollar is fixed expenses plus zero target profit divided by contribution margin ratio. So $100,000 fixed expense plus zero target profit divided by contribution margin ratio, average of 0.555, and that gives you $180,000. That's another way to calculate that, 180. Okay, so, and here you can again read about this. That it just says again about multiple products, selling costs, and margins. So here, product A has sales price of 120, and the variable cost is 100. So that gives you $20 contribution margin. In product B, the sales price is $100, but the variable cost is only 70. So 100 minus 70, that gives you higher contribution margin, which is $30. Okay. And imagine now you hire a salesperson with 5% commission. That salesperson will try to sell what? We sell the product A because product A sales price is higher and he gets 5% of it. But sales price, higher sales price, it doesn't mean we get good higher contribution margin. So for company, it's important to sell product B, but in this case, it will be important for the sales people to sell product A. So it's better to kind of, pay them based on the contribution margin of the product, not based on the sales price of the product. And you can read it in here. So this is chapter, so-called chapter 18 for cost, volume, profit analysis. Hopefully it was good points in this lecture. Definitely watch those videos on every page on this chapter 18. And also don't forget to go to chapter 18, let's say, or every other chapter you are covering, and watch those problem videos. You see, problem video solutions. So there are some of those problems that is in the chapter. You see those problems. The problems are solved, some of them in the video with explanation. So it's a very good video to watch that. Do the same thing for problem 2. In regards to margin of safety, I put also a page here for you just to see what the margin of safety is. So you can read your book, obviously, but this is an extra resource. So what is margin of safety? Margin of safety is thinking about how much of sales you can afford to lose in a bad economy and still break even. How much of sales you can afford to lose in a bad economy and still break even. So you can have margin of safety in dollars or margin of safety in ratio. And that's also part of your project to calculate margin of safety in dollars and margin of safety in ratio. Margin of safety in dollars is current sales level, whatever it is, minus break-even sales, and that gives you margin of safety in dollars. But just to understand it better, you convert it to ratio. So you say, okay, margin of safety in ratio is current sales level minus the break-even point divided by sales level. So how much sales is higher than break-even point? Whatever is higher, divide by current level sales, that gives you the ratio. Okay. And there is an explanation here, and there is also an example for you to read. And those will be also in your project to calculate margin of safety and margin of safety in dollar and margin of safety in ratio. Okay. Hopefully you like it. Bye-bye.